We do expect a kind of a choppy road to nowhere, so to speak. Maybe grind a little higher, but unless someone comes out as a clear winner in the election, or expected winner in the election, it's hard to see the market not kind of being a little reluctant going into it.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back at the end of another week, this time featuring my good and highly enriched friend, Michael Lebowitz. How you doing, Michael?
Thank you. Enriched. That's a new one.
Yeah, well, look, so you are kindly filling in for Lance while he moves into his new house. He's kept us all abreast of his saga of selling his previous house and renting for the past 2 years, and he's actually making the move today. And since you were stepping in for him, and it really is a pretty dramatic upgrade, let's be honest about it, I thought highly enriched was a very appropriate adjective.
Exactly. Well played.
All right. Well, look, lots to talk about, especially because as we're talking here, Jackson Hole is going on. Jerome Powell just spoke there. We'll talk, really have sort of a real-time reaction to his comments and what the markets are doing in response. Really quick before we get to that, one quick little housekeeping item. Folks, I announced on this channel that we passed 100,000 subscribers relatively recently, and one of the perks that comes along with that is YouTube assigns you like a personal consultant who gives you tips on how to have your channel perform even better. And one of the data points they shared with me is that two things. One is that there's a minority of people who watch these videos who have subscribed to the channel and click that little bell icon. You want to click that bell icon because every time we launch a new interview like this one, you want to get an alert that says, hey, there's a new video out from Thoughtful Money. But also, very importantly, even if you have clicked that little bell icon, again, it's right next to the subscribe button, many people, especially if you're watching these videos on a device like a phone, you oftentimes have to go into settings and tell your phone, hey, allow alerts from YouTube. Because what'll happen sometimes is people say, send me, the alert from Thoughtful Money. We'll try to send it, but the phone isn't set to let YouTube send them an alert, so they don't actually get it. So if you haven't yet clicked the little bell icon, please do that. If you have clicked the bell icon, check your device's settings to make sure you get those alerts from YouTube. All right, so Jackson Hole. Powell, very dovish, gave the market exactly what it was looking to hear. I think the hero quote coming out of it was, quote, time has come for policy to adjust. So this is basically Powell saying, get ready, folks. We're going to start cutting interest rates at the September meeting. A couple other key quotes from him. The cooling in labor market conditions is unmistakable, which is interesting because this was definitely a really topic of hot discussion in his last press conference. The media kept hammering him about their worries about the unemployment rate rising, some of the underlying unemployment data that we've talked about in the past, Michael, beginning to look more concerning than the Fed had led on, because it had always talked about the resilient jobs market. And Powell kept saying, it's normalizing. I'm not that worried about it. I don't see a major issue. He now really, though, is saying, hey, the labor market is something we're watching closely. Like this, we do not seek or welcome further cooling in labor market conditions. So basically, that's a way for him to say, look, if jobs start worsening from here, that's going to be additional fodder for us to continue cutting or cutting more deeply. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, the balance of risks. This is his, hey, we're always going to be data-driven. I'm not going to make any commitments as to size or scope of cuts. We're going to let the data decide. And then he said, we'll do everything we can to support a strong labor market as we make further progress towards price stability. So again, past 2 years have been pretty much all about price stability. Now he's saying we're back to the dual mandate. We're going to defend both with equal vigor. The last question, or last point on this, is Nick Timros, who's often looked at as sort of the unofficial spokesperson for the Fed in the media. He said, quote, the Powell pivot is complete. So, Michael, Is this true? Are we now at the pivot that the market has been dying to get since, geez, what, end of 2022?
Yeah, the Fed is going to cut rates in September. The question is 25 or 50. Right now, the Fed funds futures market assigns about a 1 in 3 chance they actually cut by 50. So basically, we have three data points between now and then. One is PCE prices next week, which Powell probably has a very good indication, if not the actual number, what it's going to be. So that must be okay. Doesn't mean it's disinflationary or low inflation, but it's probably an okay number. And then we get the jobs number the week after that and CPI the week after that. So assuming jobs or the CPI number are not train wrecks, the Fed's going to cut rates. And Powell doesn't have the jobs number, but they've done the survey already. So he probably has some indication that it's okay, that it's not plus 500,000 jobs, that it's somewhere in a ballpark or even lower.
Right.
But
And so just to be clear there, when you say it being a train wreck, like if it was a low number, that would induce them to cut more. You're saying if it's a really positive number, that would challenge their.
I take it back. You're right. It's not a train wreck. It's actually a good thing.
Bonanza. Yeah.
A bonanza. Right. And if it's a train wreck in the traditional sense of the word, then they may go 50. So, I think the important thing that's coming out of this is that the Fed is very comfortable with inflation and they're getting increasingly uncomfortable with the labor market, which, there's a lot of labor data out there and everyone talks about the BLS and it's bogus and they just revised it by 800,000 jobs. That's a known commodity. It's always been a tough number. It's based on surveys. It's based on surveys of large companies. There's obviously many small companies that are around too. So, we look at, and a lot of economists look at a wide range of data, including the JOLTS data from the BLS, which has told us for a long time that the labor market is normalizing quickly. ADP puts out data, Challenger puts out data, corporations in their earnings statements put out data, ISM surveys, PMI surveys. So there's a University of Michigan. There's a lot of labor data out there that we can rely on. And we know, now we've been proven correct. We knew those numbers were too high. And I think the market did too. The Fed knew it. The Fed has made various comments along the way that they think the number will be revised lower. So, we've seen that. We've seen the weakening. The Fed's getting ready to cut. And I think one reason is because the labor market is probably the most important component of confidence, consumer confidence. And they don't want consumer confidence to slip. So that's what can put you into a recession really quickly. So I think the key going forward is not inflation, but labor. And is it just normalizing or, are we on the path from 3.5% unemployment to 5 or 6? And that's what, we'll find out.
Okay. Now you said 3.5% unemployment, but we are currently at 4.3, right?
We're at 4.3, but that was kind of the low point. And,
Right.
and look, 4.3 is over history, that's normal.
Yeah, it's on the low side of normal, I think.
Right, correct.
Historically. So, all right. So, I feel like I've been beating that point for the better part of a year, probably close to 2 years, that really the big worry here should be labor market versus inflation. There's a lot about inflation that was going to normalize anyways. I'm not going to use the word transitory, but there were so many issues with the supply chains that we knew that they would eventually heal, and a lot of that excessive cost and limited supply would come out of the system, and that we would disinflate. And of course, that's been what's been happening over the past couple of years. Now the Fed hiked rates more aggressively, pace-wise for sure, than I think it's done in living memory, and then it's held higher for much longer than people thought. In fact, many people thought the economy could even sustain, right? And this is why I've been beating that lag effect drum so much. And I think we're now going to find out whether indeed that's a valid concern or not. Is the Fed somehow able to start cutting and achieve some sort of glide path landing here, or does it find out that we're already in overshoot and just haven't seen the full results yet, and then that's what transpires from here? Personally, I think that is a uncomfortably high risk at this point in time, and maybe that's really what's driving the Fed's decision here. But we'll see. And I do want to get into some of the jobs data with you in a moment. But interest rates are now coming down, it seems, right? Seems like that's kind of baked in the cake at this point. Does this give a green light to the long bond trade? Right. And just to recap for folks, Michael, you and your partner in crime there, Lance Roberts, have had a long bond position in. You have been very confident about it, even though it's maybe taken a while to manifest in the way that you initially thought. Every time I've asked Lance, not a bead of sweat on his forehead. Said
Right.
this is definitely going to come. Every time I've talked to you, you make it a very mathematical explanation, and I detect that you haven't had any real worries about it either. Is this what's happening right now in Jackson Hole kind of a step on the path that you guys have been anticipating for why you took that position?
Yes, and I think the market has been on that path now for a little while. That at the end of the day, inflation is extremely correlated to interest rates are extremely correlated to inflation and inflation expectations. So we know inflation came down significantly from its highs of 2022, and it kind of got stuck. So even though we were given a green light, we were stuck in traffic. We were very confident of our trade, but there were some stubborn parts of inflation that just wouldn't go down, mainly shelter, which is a very flawed statistic that we've talked about on numerous times. But it's, again, over the last 3, 4, 5 months, showing signs that it's kind of heading right back down to 2%, the Fed's target. So inflation is on its way, and inflation expectations have been falling along with inflation. They're very much tied at the hip. So again, we're very confident that inflation is heading towards 2%, and with it, the Fed is going to normalize interest rates. By normalizing interest rates, that just means they're going to bring Fed funds down. It doesn't mean they're going to bring long bond yields lower. But what happens is there is a lot of money stuck in money market funds or very short-term treasury bills or CDs or whatever it may be, and they're earning a great return of, between 5 and 6%. That's wonderful, but that train is actually, that's what Powell told us today. He
That
just
train's
said,
leaving the station, right?
exactly, it's leaving. And I think people in the next, 6 months are going to realize I'm not earning 5.5%. I'm earning 4%. And now I'm hearing that's going to go down to 3% or even lower. I got to lock this in. So there's a lot of retail money, professional money I hate using the word on the sideline, but it's in cash. And it's going to look to term out those high interest rates for as long as they can, once they gain confidence that once they gain enough confidence that the Fed has that inflation is coming down. And I think the way I've been kind of thinking about this, and I've been kind of working an article in my head, it's inflation PTSD. We just went through the biggest inflation shock of our adult lives. I certainly remember as a kid, the gas lines, my parents,
Right. But nobody under 50 does.
right. And, that was as a kid. So I didn't really appreciate it at the time. This was the biggest kind of inflation shock we've seen. And unlike the 70s, which there were numerous contributing factors which caused it to recur over and over multiple times, this was due to an event, right? The pandemic struck the world, shut down the supply lines. That was a big deal. And then at the same time, the government of the US and many other countries decide that they're going to just give people money. And it's an awful combination. And you increase demand at a time supply's falling and you get inflation. But the word transitory was correct. It's just a longer transitory than
Right.
anyone thought. But there's no reason in my mind that we're going to see further outbreaks of inflation. It's just, I think we're going back to the trends that existed before COVID, but people have PTSD. So they're scared, right? The boogeyman's still somewhere. They don't know where it is, but it's in a closet or under their bed, and they're still scared it's just going to pop back up again. And that's problematic. And it's reinforced by the way that most people think about inflation. So you go to actually my son, just went back to college, but he was home. He went to Five Guys. He said his food was $20, $21, burger, fries, and a drink. I'm like, that's crazy. He was like, I know. Can you believe it?
Yeah, and he
But
probably remembers, and even though he's a kid, when that was
right,
$12 or whatever, right? Yeah.
right, which was still expensive for what it is, but that's a different podcast. So you know, in his mind, inflation is running rampant. But that price, I don't know what, I don't go to Five Guys, but I'm assuming 6 months ago, it was also $20, $21. So what economists look at is the rate of change of inflation, not the absolute price levels, but the rate of change. And that's what's stabilized. But we're constantly reminded when we go to dinner, when we just everything we do, that prices are at a new level. And it's not good. I don't like it. Most people don't like it, but it is what it is. And our wages are also higher. The size of the economy is higher. So no one puts that into perspective. They don't say, oh, the price of bread is up 20%, but it's okay because my wages are up 20%. No one kind of puts the two together, and wages may not have gone up as much of inflation, but they've gone up a lot also. So,
Right.
you
Well,
know,
and they're a big component of the inflation.
yeah, yeah,
Why does that Five Guys burger cost $20? Is because, the rate that they're paying the fry order cooks has gone up pretty dramatically over the past 4 years.
well, that's in California. The rest of us
Yeah,
don't
it's
pay their fry cooks that much, but
yeah, yeah.
um, but the point is that we're going to have PTSD over inflation for a long time, and it's probably going to keep inflation expectations elevated until we really see signs of disinflation or deflation. So, that's just something that we have to think about with the bond trade, that bonds may not drop like a rock in yield, that they will just continue to come down, albeit at a slow pace, because inflation is on everyone's mind and we're constantly reminded of it. But to what Lance probably tells you week in and week out, and what I've told you when we talk, we are very high on the bond trade, just as high as we were a year ago. And it's worked in our favor, albeit sluggishly, but we continue to think it's a great trade. And while you're waiting, you're earning, a nice return, 4.5% return. So
So,
it's
sorry to interject, Michael, but I think this is the big question that everybody watching has on their mind here, which is, well, did I miss the boat on this, or is there still time to get in on this thing? Is there still enough of it ahead of us to make it a meaningful trade?
So there's two paths. And actually, my latest article about Fed funds futures kind of talks about these two paths. If you look at Fed funds futures, they think the Fed is going to lower rates to about 3%, which would mean that they're going to cut rates by, let's say, 2.25%, give or take a little. That's a Goldilocks scenario. What you're saying there is that the economy is normalizing and we're not going into a recession. And let's just presume that's the case, that the Fed has done something that's really it's been done maybe one or two other times in the last 50, 60 years, that they were able to engineer not even a soft landing, but just getting the plane down to the correct altitude and keeping it there. That
Mhm.
would be great. In that case, I still think inflation heads towards 2%, which should put longer term bond yields in the, call it, low to mid 3% range. So there's still a decent amount of bang for the buck, but not as much as if we're going into a recession, which is kind of the historical norm. And in that norm, the Fed cuts aggressively. I'm going to pull up a table here that was actually in that article. So what we see here are the Fed easing cycles going all the way back to 1957. And what you'll notice, if you just look up and down the list, the Fed cuts, at least since the late 1960s, by 5% or more every time. There's really two times in the last, 40, 50 years they haven't. 1995 to 98 and 2019 to 2020. 2019 to 2020, the pandemic, and even they were cutting before the pandemic, they couldn't cut anymore. And that because that's where rates started. Fed funds were at 250 approximately, and
they
they
went to
cut them to
zero.
zero. So,
Yeah.
so they could only cut them so far. 1995 to 98 they weren't really economic rate cuts like we typically see. They were kind of crisis, and I use the word crisis loosely, but crisis driven. 95 was Orange County. They had raised rates so quickly that they basically put Orange County, California into default and were creating other problems for financial firms and municipalities, and just because they raised rates too quickly. So they cut a little bit in 95. And then in 1998, we had Russia bankruptcy, Asia, long-term capital. So again, they cut rates a couple times, but nothing meaningful. It wasn't again until 2000 where they really cut rates by, 5.5%. So, when you kind of look at the historical data, there's really one data point, 1995 to 98, that stands out where they lowered rates, not into a recession. So I think the odds favor that they're going to be lowering rates and potentially into a recession, meaning that if they cut rates by, as you can see, 5% is the norm. That brings rates to zero. But even if they cut them down to 1 or 2%, they're, a little less aggressive than they've been. That should do wonders for long-term bond yields, get them down in the low to mid 2%, if not, potentially a lot lower if it's, if we do go into recession and it's a deep recession. It wasn't that long ago that the 10-year rate was 0.5%. So I still think there's upside. The question on how much upside is to be determined. And a lot of that is what's going on with the economy. If the Fed lowers rates, will that kind of bolster the economy and protect it from a recession? And I think the important consideration with that is what we just saw was that higher rates didn't really impact the economy too much. And it's because a lot of people took out mortgages at 3% before rates rose, and they refinanced and did that, or they bought new homes. And a lot of companies refinanced their debt at very low rates. So this bought the economy time. They didn't have to borrow.
Right. Plus all the stimulus, just FYI, but yes.
Yes. There are a lot of factors, but the same holds true. Typically, when the Fed cuts rates, people refinance, and that creates additional income, right? Instead of paying $2,000 a month for your mortgage, you're paying $1,600. That's $400 you can spend on something else. No one needs, there's very, very few people that need to refinance if the mortgage rate goes from 6% like it is today to 4%. You're not really helping enough people to matter.
You're not going to get that boost. Yeah, I get it.
And same with the corporations. There was very little debt so far that's been issued at 5, 6, 7%. So there's very little debt that needs to be refinanced. So,
sorry to interrupt, but just to underscore this point, it's really important, which is rate cutting. Everyone loves rate cuts because there are all these knock-on benefits that come from them. You're saying we may not get the scale of benefit from a rate cut cycle this time around, only because so much of the system is already locked in on much lower rates.
Well, I think the marginal benefits start increasing rapidly when you get down to 10-year yields of south of 2.5%, 2%.
Sure.
And
that's pretty far from where we are.
And that's the problem. There's kind of this gap between where we are and where that is. And the Fed, by cutting once or twice or three times by 25, isn't, who knows how the long end of the yield curve reacts, but it's probably not going to get them down there quick enough if if the economy starts rolling over.
Right.
And that's the big if.
Well, let me ask this. So I mean, you're right. The Fed can influence the short end of the curve. It can't influence the long end of the curve. But there usually is some transmission. Usually if rates are coming down, if the Fed's bringing Fed funds rate down, usually we see some sort of similar movement on the longer end of the curve. Not always, but usually. But let's say the Fed is cutting, and then the economy falls into recession. That's going to probably influence the Fed to cut even more on the short end, but B, that's probably going to create a flight to safety on the long end. So in some ways, recession only helps your bond trade, correct?
Right. Especially if the stock market declines as part of the recession, which is typical. And it's also typical. It's funny, the market's cheering. Today the S&P's up, before we got on, it was up 40, 50 points. So it was up before Powell started speaking, but it jumped afterwards because it loves rate cuts. The market loves rate cuts. But if you go back in history and look, the market hates rate cuts. They're cutting
Right.
rates because of a recession, and the market has always gone down a decent amount when the Fed cuts rates. So it's it's this interesting dichotomy we live with. While we're waiting for rate cuts, that's bullish, but it may not be so bullish once the Fed starts cutting rates. And again, as stocks start going down, to your point, Adam, people are going to look for something else. They're going to look for safety, and bonds, which will be coming down in yields, most likely will provide that kind of port in the storm. And it may even be more of a port in the storm, a better port in the storm, because yields are higher today than they were, in 2019. 2020 was a different animal, but even when the Fed started cutting in.
Well, so a couple of things. First off, I just want to show this chart, which I've shown many times before, but this is a chart of the federal funds rate. And to Michael's point there, every time the Fed is hiked and then plateaued and then starts cutting, we enter recession and the Fed is just in a desperate scramble to cut rates. And we've seen that every time. We even saw it in the pandemic, although I don't like to use that one just because that's sort of a special case, but we still saw it there. But every other time here in the data series, that's what you see. And of course, we've hiked really aggressively, we've plateaued. Now we're just beginning to cut rates. So you have to have an argument for why things would be very different this time. So let me ask you a question here, Michael. In all of these historic cases here, when the Fed starts cutting, it is what they call behind the curve, right? They waited too long, the economy started slowing more than they expected, and they're in this desperate scramble to cut to try to boost the economy. What does your gut tell you? Is the Fed behind the curve again this time around?
You know what? Over the last 3-4 years, the economy has been very humbling. It has proven extremely resilient to very high rates. So again, I'm not sold that I think we're going into recession at some point, but I'm not sold that it's in the next 3 months or 6 months. I just think there's a lot of resiliency still in the economy. And you have a government that's spending an awful lot of money. And, who knows how that translates to the new president and new Congress. But everything we've seen, that both parties love spending money, and we should expect it to continue, which should also buffer the economy to some degree. So I'm not calling for an imminent recession. Obviously, a recession will happen in the future. They always do. They always will. You can't eliminate the business cycle. But, I think it's just very important. And this is what the Fed talks about all the time. They're data dependent. That means they're following data closely, where, it's not just looking at CPI and the BLS jobs data, it's diving into the nooks and crannies of those reports and so many other reports that are both public, provided by the government and private institutions, to really look for the rate of change, the trend changes, not forget the absolute numbers, right? Everyone says the BLS is a bunch of lies. That's fine if you believe that. CPI, they don't know how to calculate inflation. Take it for what it's worth. But what you can follow, even if you don't like those reports, are the trends. Is unemployment going up, up? Is it just kind of flatlining? Are prices going up or down? So, even if you don't buy into the government reports, those trends are still very important. And there's plenty of other collaborating data that'll kind of help you appreciate how good those government reports are.
Okay. Um, I'm not sure if you fully answered the question, except to say it's a humbling environment. Maybe you don't want to stick your neck out so much on whether history is going to repeat with the Fed being behind the curve or not. But that's okay. It is a challenging time,
You
and
know
most
what?
importantly, that's why we have you and Lance on this channel every week. Anyways, you get to kind of call an audible based upon what you see.
And here's what the last article, and I think I've said this 100 times in the last year. This time is not different. It's elongated. There are some circumstances that are different, but every one of those trends that really dictates economic growth, productivity, demographics, debt, they all argue that rates are going to be lower, that inflation is going to be lower, that economic growth is going to be lower. And if you look at the Fed's forecast for economic growth, the private sector economists, they're all telling you that GDP will be running below 2% in the future, that inflation will be 2% or lower in the future. And it's because those underlying trends have not changed.
Got it. Yet Wall Street's still expecting earnings to grow by what, like 20% year over
They
year?
always do. But then when you get to earnings, that number will be down. So
Right. Right. Yeah.
part of the game.
Okay. But anyways, I just want to underscore it sounds like your thesis for your bond trade does not depend on recession. Recession is sort of like, option value on it. But you, for the reasons you mentioned, you think that yields are going to come down. That's going to benefit your bond position. And then if we get to a recession and there's a flight to safety, that's just going to be an additional kicker that kicks in here.
Right.
One other thing I want to note about here, because you mentioned this briefly earlier, but I think this is important for people to realize. As the Fed begins to bring rates down, so let's pick the soft landing scenario. There's no recession in the next year or two. Even with that being the case, if the Fed is bringing the federal funds rate down, that is going to bring down the yields that everybody doing the T-bill and chill trade right now have been enjoying, right? So there's X trillion that's moved to T-bills and money market funds, et cetera. Those folks are going to, it's been a really wonderful time for folks who wanted to park in safety and get paid for it, right?
Mm-hmm.
So that era is ending. And if stocks do not correct in the near term, there's a fair amount of people who are probably going to say, look, I've got my money in this trade I've loved, but that trade's going away. I don't necessarily want to put it in the stock market because the stock market seems just way too rich right now. Where can I put that money? I guess I'll go out on the yield curve, right? I guess I'll try to lock in these rates, as you were saying, and see if I can get them for 2 or 5 more years, right?
Right.
And so there could be a pretty big migration of money out of the T-bill and chill trade and money market funds further along the curve, just kind of out of physics here, where people are just like, I still want to be safe. I don't want to roll the dice in stocks. What are my options? I guess it's longer dated treasuries.
Right. They're going to look at the menu of yields and say, oh, for 10 years, I can earn 4%. Or, it's now 4.5%. It's 4%. It's 3% for the very short term stuff. And I think that menu for further out for duration will start looking better and better once those appetizers that look really good right now are taken off the menu.
Right. And especially, I mean, then we're talking about a soft landing scenario, but let's say people start getting increasingly worried about recession. Then it's like, yeah, I don't want to be in stocks. And yeah, my T-bills are going down in yield. So yeah, I mean, now it seems really good to go into longer dated treasuries because I'll get the safety, I'll get that return for longer, and I might get some price appreciation in the mix too.
Right. Now there is one caveat to this whole thing. If we do go into a recession and the government pulls out the COVID playbook where they just give people money and the Fed backs them up by doing tons of QE and lowering rates, inflation expectations and inflation could rise. So while short end rates go down significantly, 10s and 30s may, go down slowly or may just flatline or could even go higher if inflation expectations are resurrected. So, what we recommend is you don't just put all your eggs in one basket and buy the 10-year or 30-year, but you think about a ladder. So a ladder is where you buy some short-term, some mid-term, and some long-term bonds. And that way you're kind of hedging yourself within the big range of potential outcomes.
Yeah, so great point, and that's going to lead me to another question in just a second. But obviously, Michael, firms like yours, for people that aren't that experienced buying bonds and maybe have never structured a bond ladder, that's something you guys can obviously help advise people through, right?
And that's what we do it all the time. And that's the way we have the bond positions within our clients' portfolios are all laddered to some degree.
Okay. Now there are ETFs out there. TLT is one that's been talked about, on this channel an awful lot. And I think you guys actually started your trade in TLT, but then you actually moved into individual bonds, building, I'm guessing, your own firm's ladder there
Right.
as well. Any particular thoughts on ETFs versus the individual bonds themselves you want to mention to people?
If it's a buy and hold, I'd rather own the bond. But if it's a trade, and by trade, it can be a 2 or 3 or 4 year trade. I'm sort of indifferent. I do like the bond better. First of all, a lot of clients seem to feel more comfortable having the bond and its CUSIP on their books versus, a little less clarity as to what TLT is and what they do and what they own. So there are some benefits, and there are benefits to it's called rolling down the curve. So when you buy, let's just say you're choosing between a 10-year bond and a 10-year ETF. Well, in 2 years, your 10-year ETF is still going to be a 10-year ETF. Your bond is going to be an 8-year bond. And typically yields are upward sloping. So short-term yields are lower than higher-term yields. So as you roll down that curve, you're rolling down into lower yields, i.e. higher prices.
Mm-hmm.
So again, the longer you plan on holding it, the better we like holding the CUSIP, the bond itself. But for a trade, we're fine either way.
Okay.
Again, we prefer the bond CUSIP, but perfectly happy if you do own TLT or EDV or one of the other bond ETFs.
Okay. So talking to Lance every week, I kind of get the sense that your bond position is a trade, meaning I think he feels that, and you may feel the exact same way, so please chime in if you do, but he feels that odds aren't bad that if indeed we started rolling into a recession, the Fed would pull out the COVID playbook. And so, there's going to be a moment of in the nearer term, and by nearer term, it could be 3 to 6 months, it could be a year and a half to 2 years, we don't know yet, where you're going to ride the appreciation on the long end of the curve that we've been talking about. But then if indeed the Fed and fiscal authorities come in and just start pumping the system, with tons of stimulus, that would probably very much be the, hey, we're going to get out of this trade moment for the bond position. And again, we have no idea if indeed that's the way it's going to flow and what the timing is going to be on it. But my understanding is he's kind of got his eye on that potentiality happening. So do you guys really look at it as more sort of a multi-year trade that you'll get out of if you see that happen?
Yeah, why would we, if the 10-year goes down to 1%, what's the benefit of holding it at that point, right? We've made coupons 4.5% yield for a while, but we've made some, if the yield on the 10-year goes down to 1%, we've made some really good price appreciation as well. So at that point, what's the benefit of holding a 1-year treasury bond? The fact that it could go to zero? Yeah. Yeah. I mean, there are benefits to that. Will it go negative? Never say never, because that was a thing prior to COVID. But, the upside is very limited at that point. It's kind of like a stock with a very high valuation. Its upside is limited, its downside is immense. So especially knowing that one of the things that makes this upcoming environment different is the new playbook, that they can not print money, but they can basically helicopter drop money to people. They know people will spend it and instantly boost the economy. And having that prospect out there doesn't make it very comfortable holding a bond where you're only getting 1%.
Right.
So yes, this is most likely a trade. Again, whether we're going to hold it for another 6 months or a year or two, we don't know at this point, but it's certainly not a permanent position in our minds.
Okay. All right. Well, I've been having people for weeks and weeks, asking for updates on the bond trade, and I think we've just given them a really, really detailed one. So thanks there, Michael.
You're
Well,
welcome.
if we can, let's move to the equity side of the story for a minute. And I don't know if you've got this same ability Lance does. Every week, he usually pulls up a chart of the S&P from Simple Visor, and we look at the daily moving averages and whatnot. Just kind of look at a little bit of the technicals. If you're able to do that, great. If not, no worries. But the head of Goldman Sachs's hedge fund division, he just came out with a report saying that, quote, the risk reward is not compelling right here. So when we're talking about stock market valuations, stocks are pretty much back up to all-time highs as we're talking here. Let me see if I can pull he makes both the bull and the bear case, and I'd love to get your thoughts on both. He says right now the bull case is earnings growth is stronger than expected. The U.S. economy looks like it'll remain durable going forward, and the Fed is set to deliver, he says, 200 basis points of rate cuts over the next 18 months. With that said, he doesn't like the risk reward trade-off because right now valuations metrics are objectively demanding, and the market bounced remarkably hard off the August 5th lows. He expects that stock operators will struggle to weigh the distribution of various election outcomes, and we'll talk about the election in just a minute. He also says the narrative around AI is increasingly becoming more two-sided than it was just a few months ago. And that's something that I've talked with a number of people on this channel. I'd love to hear your thoughts about it too, Michael, but is that, so much money has been going into AI, and for long enough now that I think the people that are spending all that CapEx are beginning to say, hey, wait a minute, are we seeing any real movement of the needle, either on our revenue or our profit margins, to justify the hundreds and hundreds of billions that have been put into this space? And if they start getting cold feet to a certain extent, or even a wait and see, like, let's just dial down our buying for a while and let's just see what we're going to get from what we've already done, that could really puncture the AI mania that's powering so much of the market right now in those top stocks. So anyways, I'll condense what his key takeaways were, and then I'll let you run on this. He says it's still a bull market and the primary trend remains higher, but I expect the trading environment will be choppy over the next 3 months. Whereas distinct from the past month, both upside tail and downside tail will be constrained. And Lance has said the closer we get to the election, he expects markets to start de-risking a bit. So he says, therefore, I would stick with the plan of staying in the saddle, but simplifying your portfolio to the best assets and holding the reins tight. So he's not like saying everybody get out of the pool, but he's not saying, hey, lean into this and go aggressively long. He's saying kind of like consolidate to your best horses and just watch them closely and ride them here. So what are you guys seeing and thinking right now at RIA?
I think what he just said is perfect. I mean, that's exactly what we've been saying. Lance is preaching it week in and week out on your show on the newsletter, that we're due for a couple months of some volatility and probably stagnation. The election is a big deal. It's very close at this point. No one knows who's really going to win. And, to some degree, it's also important who wins Congress and, alongside with the president's party.
Right.
And so there's a lot of unknowns, and then you throw in the whole affairs in the Middle East. Will there be a peace treaty between Israel and really Iran, right? Because Iran's the
Right.
real,
They're backing the,
they're
yeah,
backing it, but
Hezbollah
but
and
and
Hamas.
importantly, that's where oil comes from. And oil is such a big component of the global economy and our economy. So, that I think is on the back of people's mind. And this yen carry trade business probably isn't over. You don't usually get a huge spike in volatility and then nothing, right? So we should expect just some trading volatility. And yesterday we saw a little bit of that on Thursday, where basically the Magnificent Seven got hit hard, but the rest of the market was relatively okay. So I think what the Goldman analyst said was kind of right on. It's going to be a choppy few months. Uh, we're holding. We have de-risked a little. We have cut our exposure a little, but we do expect a kind of a choppy road to nowhere, so to speak. Maybe grind a little higher, but unless someone comes out as a clear winner in the election, or expected winner in the election, um, it's hard to see the market not kind of being a little reluctant going into it. I have I don't know if it's the simple visor graph that Lance shows, but I'm going to show this was the high on July 16th. That's where the market peaked, and we're just about there. We're a hair off it. And you can see as we've approached that high, we're started to level off a little bit. So maybe we'll kind of double top here. We'll go down, we'll test a couple of those moving averages that you can see we're above right now, and then possibly go higher from there. But we are definitely overbought here. Bottom is our relative strength index, the RSI. It's not in overbought, it's not where you would want to necessarily sell it, but as it gets close to 75, where this red dotted line is, it's becomes a little more troublesome. But be careful because it can stay above it for a little while. It kind of did that all the way from June 11th to for a month between June 11th, July 16th. MACD as well. We got a nice buy signal, and we had a nice buy signal on the RSI, both signifying that there was some rally to come, but we're starting to get high up. It can certainly go higher, and it can certainly extend. And we can, again, just like kind of May, June, July, that the MACD can stay high and it kind of oscillate between buy and sell signals without really giving us a good sell signal. But the market is overbought. It's gone, kind of too far, too fast. We had 8 days in a row there, got broken up this week of gains, and that's a rarity. But I think it shows you a couple things that, for one, there's still a lot of buying power out there that people will take advantage of any dip to buy. So that's important. The other big deal is that stock buybacks are occurring now, that we got past earnings and companies can buy back their stocks. That's a huge impetus to the market. That unfortunately starts going away pretty soon because we're going to start heading into October when they have to cut off from those buybacks. But there are a few more weeks between now and when they start shying away from buybacks. But I think what you said about the Goldman analyst is correct. Chop. But we're not really selling. We're staying in a saddle, as he said. And there's nothing that tells us that this bull market is over technically. Nothing really fundamentally, right? The economic data is a little weaker, but at the end of the day, it's a far stretch to say we're in a recession right now. Doesn't mean, look, things change rapidly. And a lot of that, again, is kind of can be based on confidence. So it's not a mathematical formula that tells you we're going to have a recession in 4.6 months. It's a very dynamic environment. Much like the weather. The way things change in the weather changes the weather. And the way confidence changes, the way can change economic data, which changes confidence, which changes markets, which changes confidence. And there's this whole back and forth that can really push a seemingly good economy into a recession relatively quickly. So, again, we're following a lot of stuff closely because there certainly are concerns. There is a potential recession. And one of those are just various gauges of sentiment and confidence of consumers and business leaders.
Okay, so let's actually talk about that because you recently wrote a piece on confidence, and I one thing I particularly liked about it is it echoed an idea that I have mentioned on this channel several times. But you're right, which is you to have a change in trend in the market, you have to have a change in sentiment, right? You have to have something that causes the marginal buyer to switch from, either, net long to net short or vice versa. And when sentiment shifts, all of a sudden, lots of things that weren't possible before or imaginable beforehand, all of a sudden become very possible. And you talk about this concept of common knowledge, which I know Ben Hunt has sort of had this framework for years, which is sort of like in his thing is the emperor. He mentions the emperor has no clothes, right? Like everybody can see the emperor is naked, but nobody's acknowledging it. So I've got this private knowledge that I think this guy is naked, but I'm not willing to voice it because I'm going along with maybe I'm wrong. Maybe I'm seeing something different than everybody else is. But the minute the little boy says, "Hey, this guy's not wearing any clothes," and it all of a sudden becomes common knowledge that we're all thinking the same thing,
Right.
then all of a sudden, everybody reacts differently. And I use the same example you did, which is the what happened to Biden post the presidential debate with Trump, where the minute before he stepped up on stage, the Democratic machine was very confident about their chances. Publicly, nobody could say that Biden had any real issues. Those were deep fakes or cheap fakes or whatever. And a minute after the debate, the entire tenor had changed, right? And then of course, here we are not that long after, and Biden's already given up the presidency, and all these things that didn't seem imaginable right before the debate all of a sudden became possible afterwards. You also had a similar analogy of Harvey Weinstein, where he's sort of known in the industry as being this really bad actor, or I guess bad producer, but a bad guy, and yet nobody was willing to stick their neck out there and say it because they were afraid maybe they didn't fully understand the situation. Once it became common knowledge, everybody came forward, and this hugely powerful media mogul got ousted, right? So the reason why I like to talk about this shift in sentiment is, once you have one unveiling like that, it does beg the question, well, gosh, what else have we been taking for granted that might not be the way that we think? And you talked about how important you think the labor market is going to be going forward and determining what's going to happen, with our economic destiny. There have been so many people who have had so many questions and doubts about the labor data coming out of the BLS, and then we had this massive downward revision. I'm not saying that that's necessarily one of these common knowledge moments that's going to change everybody's sentiment, but I think it does make people think, oh, geez, maybe the labor market is an awful lot weaker than we've thought. And, policy's been made on how strong we thought the labor market was. The markets have been trading on how strong we thought the labor market was. So again, I'm not saying that downgrade we had is going to all of a sudden start a cascading lack of confidence in the system. It could, who knows? But it begs the question, what else are we taking for granted right now that, all of a sudden we might realize is not as firm as we thought. And then that then creates the sentiment shift that you're talking about, where people go from feeling net confident about things to net worried about things. They change their behavior, and then, all of a sudden something like a recession or a hard landing, which, a lot of cheerleaders right now are just saying can't happen because it's soft or no landing as far as the eye can see. Um, you know, I guess where I'm going here is like how worried are you about the ability of some curveball like this to sort of transform confidence on a dime, and all of a sudden, no recession in sight to, oh my God, it looks like we're falling into one this coming month.
I think it is the labor market, but it's not from an investor's point of view. It's not whether we think that 800,000 jobs that were revised was BS or real, but it's what's our personal take of the labor market. Are we comfortable? Are you comfortable in your job? Are you confident that you're going to get a raise come January or February? Get your bonus as you always get? Are your do you look around the office and are the same number of colleagues there? Did a colleague just get fired? Do you see the bottom line of your company? Is it starting to fall? And are you starting to question whether they're going to lay off people? So there's I'm going to share my screen here again.
Right.
There were,
And sorry, and while you're pulling that up, I just want to note some, recent stats that have come out. Like people are reporting I think it's harder to find a job right now in today's economy than it's been, I think, in like the past 10 years.
correct.
When a lot of the data is anecdotal, but there's increasingly now some, at least survey data and things like that are showing that people are saying like, this is not, like Powell still talks about how there's still more openings than there are applicants and stuff like that, which gives the impression that, hey, anybody who wants to get a job can get a job. That does not seem to be the boots on the ground reality for the majority of people.
No, and there have been a lot of changes since COVID. A lot of companies keep they keep job postings out there. And, I guess if they got the perfect employee, they may hire him, but there's a lot of extra job postings than there are real jobs.
Yeah, they're
But
like I don't know how to describe it, maybe catfish jobs, which are like,
yes,
we're not really hiring for this thing, but if we end up getting some amazing candidate, sure, we'll hire that guy, but we're not like actively trying to fill this role, even though we have it on our website.
right. And before I get into the graphs, there's also labor hoarding. And this is basically where companies hold on to employees because of the PTSD they just went through where they couldn't find employees to work and they would pay bad employees a lot of money to do the jobs. So they're hoarding labor for now. And my brother is he's in marketing, does printing. I talked to him. He tells me, look, I'm still holding on to some of these people. I don't like them. They don't do a good job, but I'm scared to death that if they leave, I can't replace them. Now, that will all change in a heartbeat once his revenue starts going down. But for now, he's in the unenviable position of having to hold on to employees he doesn't necessarily like. Now,
So
hopefully, his employees aren't listening to this, but
right. Hopefully.
I'm sorry, Todd, if they are.
I'm glad you mentioned it though, because I've mentioned this too, which is that's a really important sentiment milestone if we hit it, right? Where I've sort of likened it to a balloonist, right? Like you do everything you can to try, if the balloon is starting to sink, you do everything you can to try to generate as much new fire and heat to get hot air in the balloon. But once you get to the point where you realize that that's not enough, you just start throwing whatever you can out of that balloon weight
Right.
wise to try to reduce your weight. And I think that's what these employers are like, where I've been labor hoarding because I've been trying not to throw things out of the balloon. But man, if I'm doing everything I can to goose revenues and it's just not working, yeah, I got to start ditching these bodies, especially if I don't feel like they're high functioning ones.
Right, right, exactly. So let me share a couple graphs with you that I think are very telling. I stumbled across both of them over this past week, so they're very up to date. The first one on the screen now is from the New York Fed. So again, this is the Fed telling us this, that the expected job transitions, in this case by job transition, there I've only highlighted the unemployed, they 4.4% of people expect to be unemployed over the next, I believe it's 6 months, or 4 months. That's more than we've seen since 2014. But Adam, what's really stunning is that's more than we saw during COVID, during like 2020,
Right.
spring of COVID, when the economy was shut down. How could you not think it's a possibility of being fired? The
Well,
second
maybe in COVID is because they already all had been fired, right? I mean, there was like 30 million people who got fired, right?
That's true. That's true. The second one is the University of Michigan. They put out a monthly survey that I think is one of the best surveys of consumer sentiment. And they ask these people a lot of questions. And one of them is, what are their expectations for change in their income over the next year? And you can see that over the last kind of 6 months, it's plummeted.
That's god
But
awful. Yeah, look at that.
yeah, but it's at levels again. They got a little worse during COVID, but it's at levels again not seen since 2014, when we were still recovering from the financial crisis. So you there are signs that people are starting to get a little concerned, right? Not signs that people are necessarily getting fired. There are a few getting fired, but that's not the problem. So this the I can you can see there's two pictures here, right, Adam?
Hmm.
And you take a quick look at them, you're like, they're identical, aren't they? Well, they are, except for there's one table in the front, I don't know if you can see my cursor, that doesn't have three people at it. So you have this restaurant of about 50 people. The one on the left is packed. It's got 50 people. The one on the right has 47 people. That's a 6% decline, assuming everyone eats the same thing, a 6% decline in revenue for that restaurant. If the economy fell 6%, GDP fell 6%, that would be a much deeper recession than we've seen in our lifetimes. So the point in showing this, and I actually hat tip to my wife, because in 2008, when things were getting really bad, we were at a restaurant and I made a comment like, can you believe how crowded this restaurant still is given everything that's going on? And she said, yeah, but we didn't have to make a reservation. And there are a couple empty tables and there's no kind of line of people waiting to get a table. And I really thought about a lot of what she said. And the point is, it doesn't take a lot for just some people to lose confidence and just, instead of going to, a fancy dinner, go to a cheaper dinner, or instead of going to dinner, eat at home, or not go to the movies, or put off buying a car. It takes very little. Again, a 2% decline in GDP is a big deal. So if 2% of people really change their habits, or 6% marginally change their habits, it can have enough of an effect. So that's why confidence really matters. And those first two graphs are telling me that there's an increasing number of people that are starting to question their employee status. And that will, for some of those people, that will translate into spending less. And, so again, sentiment and confidence are so important to follow. And we had that yen carry debacle a few weeks ago. That probably didn't shake confidence, but we can see that if the stock market weakens, that too can affect confidence in the economy, which then translates into confidence in people's jobs. So, in addition to following all this economic data, it's very important to try to get a gauge for sentiment and try to understand all the sentiment gauges, because there's a lot of flaws in those too, and there can be some very bad signals.
Mm.
Um,
You're making me think I should get Peter Atwater back on the channel soon. He's a behavioral economist, and sentiment, confidence that's the main vector that he
exactly.
looks
I
through.
definitely would, because I think he can kind of tell you what to look for, when to look for it, those type of things.
Yeah. What I think a really important takeaway from what you just said that I want to underscore here, because I'm going to steal it going forward, is we tend to think about a sentiment shift where everybody thinks one way and then everybody thinks the other way. But you're saying basically, hey, for things to change materially, you don't need the whole herd to bolt. You actually, like, just a small percentage of the herd can actually make a big change, right? So like, let's take your restaurant example. Those 3 people don't show up in that restaurant, right? 6% decline in the restaurant's business. Most restaurants have pretty thin margins, right? That could be the difference between the restaurant staying in business or not, even though the room still looks really packed. Just that one table difference could be the difference between, could be the existential difference or not.
Well,
So
and
yeah, we don't need that many consumers to change their behavior to maybe cause a ripple effect to start the snowball that you're talking about rolling.
right, but it's also all those other diners. What if what if none of them ordered dessert because they're just a little, prices, they're a little concerned about spending too much. So you still have the restaurants packed, but not everyone gets dessert. It can have that same effect. It's not the entire population, but it's a part of the population, and some will just spend a lot less, but others will just kind of, clam up on the money here and there. And all of that can have a big effect. And the problem with confidence is you can't really predict it, and it can change rapidly.
Right.
So
you got to be really careful about it. Yeah. And we got to be looking at all these
and,
indicators. So
and that's why the election matters. And that's why Goldman is a little apprehensive. That's why we're a little apprehensive, because feelings are so mixed on the 2 candidates and you can see this in all the survey polls. The Republicans are much more down on the economy than the Democrats. And it switches at the elections. Like the lines are just stunning how they just cross. How when Trump won, the Republicans' confidence grew and Democrats shrank. And then when Biden got elected, the opposite. They trend in the same direction, but they kind of flip on a dime. So given all this consternation about who's going to win, I think we'll just weigh on confidence at least until the election.
Well, and look, I'm no political analyst, but Trump obviously got a massive boost post the assassination attempt and the Republican convention, and now Kamala is getting her boost from the Democratic convention. Once the dust settles from all that, it would not. Personally, I think the race will really tighten, and there's going to be a lot of guessing of which horse is in front now, because Kamala's surged in a bunch of polls, but she's getting the honeymoon treatment from the media right now. Again, once that starts waning, once it really gets down into debates and policies and things like that, and nobody has something extraordinary lifting them, and it's just the down and dirty part of the presidential race. Yeah, it's probably going to get a lot tighter, meaning the uncertainty is going to get a lot higher too. Right. All right. Well, look, it's interesting. I could talk about this topic forever because I think, sort of so goes the consumer, obviously, so goes the economy.
Right.
I have an interview coming out tomorrow, the day after this one, with Wolf Richter, who is German. And so, like any good German, Wolf is very emotionless. He just looks at the data. And, in a nutshell, he says, look, I've been expecting a recession for a long time, and I've been looking for it. I'm still not seeing signs that one is imminent by any stretch. And I would say maybe the biggest sort of surprise I had in the discussion with him was he actually thinks the middle class is doing pretty darn well in the US right now, where most of the data that I look at or the people that I talk to tell a story of the K-shaped recovery, right? Where you've got the top 20% doing really well and everybody else sort of falling further behind at varying speeds, right? And one of the things I've talked a lot about is the importance of understanding the difference between the mean and the median. Because, one of the things Wolf says when we kind of get into this is like, hey, look, I'm just looking at the consumer spending and it's hanging in there, right? And I'm like, yeah, but how much of that is being propped up by the short end of the K, the top 20%, who are doing really well? And I don't know what your mindset is, but if that's true for a moment, that it really is the affluent consumer that's really kind of been holding consumer spending together. Do you see any cracks or any signs that might lead you to think that those people might be stumbling? It might start stumbling a little bit more too, or at least they might stop ordering dessert, or maybe in the case here, they might stop ordering the bottle of Cristal, right?
Right.
Yeah.
Yeah, again, but within the top 20%, there's tiers, right? Warren Buffett or Elon Musk aren't going to order something because they're concerned they're going to lose their job. They're going to do whatever they want to do, the ultra rich. But
Right.
there's many classes
Right.
within that.
But there's only so many things they can buy. There's only so many meals they can
Right,
eat, even if they're paying
right,
top dollar for it, right? Yeah.
right. But I think a decent chunk of that top 20% can and will change spending behaviors based on the economy, based on the financial markets. So, and then the middle class has been eroded. It's not what it used to be. So you have much more poor, lower income classes that are very dependent, that their marginal purchases are very dependent on each paycheck. And the other thing to note is that we're starting to see signs that credit card debt, which was soaring, is finally stopping. And we know that savings are very low right now. So the
Right.
means to consume outside of your paycheck, savings have been depleted, and credit card debt has probably hit some sort of shorter term limit where
Like a
there's a lot
saturation level,
of
like they just,
saturation level.
yeah.
And we're seeing delinquencies rise, defaults rise, and credit card debt. So they're
Yeah.
all signs that some subset of consumers are hitting their limits just from a quantitative perspective.
Right. Well, listen to this. So there have been recent sales guidance cuts from the following companies: Williams-Sonoma, Target, Macy's, Home Depot, Lowe's, Estee Lauder, Nestle, Kraft, Heinz, Hershey, PepsiCo, Marriott, right?
Right.
I mean, these are all big consumer brands, right?
McDonald's just came out with another meal deal. Walmart cut prices on, I forgot how many, 100, 200 items. They're all adjusting to a much more frugal consumer. And that's why I said earlier, I said there's a lot of data points, but earnings reports can be very good to try to appreciate, get past the earnings per share and the revenue and all their numbers. Listen to some of their statements. They're telling you the consumer at a minimum is back to the way they were in 2019. And some of them are telling you that the consumer is weakening, that
Yeah,
consumption
I
is
think most
weakening.
of these, I'm not hearing them say, oh, the consumer's normalized. It's, oh, no, we're seeing like weak, weakening
Right.
consumer demand. It's not like a, oh, we're back to normal. It's definitely more of a cautionary tale.
Right. And I saw Target released earnings, was it I think it was this past week. And the stock was up a lot because, they said their earnings and revenue were a little better than expected. They had some good things to say, but their revenues grew, I think it was 1.9%.
Yeah.
That's
Well,
that's
do you know why their numbers were so good? Is because they had gone through a price slashing uh, campaign.
right.
So basically, to attract that business, they had to do deep discounts.
But what's CPI running now? Approximately 3.5%,
Mhm.
right?
Sure.
Inflation's 3.5%. Their sales are, let's just say, growing 2%. That means if you strip out inflation, their sales are shrinking 1.5%. So, it's inflation makes things look better. But again, as inflation comes down, things won't look as good as they did in the past. And that's just an important fact with a lot of data. Understand whether it's real, which means it's inflation adjusted, or nominal. And that can really skew the way you think about some of these reports that may seem good.
Right. Well, like retail sales, I mean, those numbers haven't really gone anywhere for a good
No,
while, right?
right, right. They
And then
flatlined.
they flatlined. Yeah. And then when you apply inflation to that, you're like, oh, well, actually on a real basis, they're trending downwards.
Right,
Um, and in theory, you would expect with inflation, you'd expect to be if the consumer is hanging in, you would expect to see retail numbers sales numbers going up just because the prices of what they're even if they're buying the same number of things, the
right,
prices of those things are going up because of inflation. So
right.
even flat is basically showing a decrease in demand, right?
Exactly, exactly.
All right. Well, Michael, look, it's always great talking to you. I don't know why we have that Lance guy on the channel most weeks. Um, as we start to wrap up here, can you give us an update on what recent trades, if any, you guys have made over the past week?
Um, I don't think we did anything this past week. We've been really sitting on our hands. So we trimmed a little exposure before. I mean, fortunately, before the yen carry trade. The market was getting a little overbought, especially the Magnificent Seven type stocks. So we had trimmed that. That was timed nicely. We've done a little bit around the edges, increasing some exposure, decreasing a little exposure to certain stocks that we like. I think it was last week, we sold a little bit of our energy stocks. May have been early this week, but I think it was last week. We sold we cut our energy exposure in part because of some concerns of a recession. And then the other is that this whole Israel-Hamas peace treaty seems to be gaining speed. And if that happens, that basically means Israel and Iran have signed a peace agreement, which bodes well that the price of oil isn't going to spike because Israel goes after Iran or vice versa.
Yeah, and maybe Iran will clamp down on some of the terrorist action in the Red Sea and whatnot. That's
right, which should
currently
also
adding
help.
additional uncertainty. Yeah.
Right. So that should help as well. But generally we're kind of sitting on our hands. We know we're going into a period where volatility may be a little increased, where we kind of drift higher or stagnate. And we'd like to add back some of our exposure, but the market now is very overbought as well. So, if we see a decent pullback, maybe we'll add a little bit more, but we're very comfortable with our risk position right now in both stocks and bonds. So,
okay, so you're riding your best horses, you're staying in the saddle, you're
it's
keeping the reins
working.
tight,
It
just
doesn't
like the
always
Goldman
work,
guy.
but it's working, and we're gonna stick with it for now.
All right. So Lance and I generally end these weekly discussions with a rant of some sort, which really is just more sort of an observation of something going on in culture or society that we think is notable for folks to keep in mind. Because you're a sports fan, I thought maybe we could just talk for a minute or two about the importance of sport. We just went through the Olympics, which is always such a great inspiration for just human ability and human achievement, right? So let me make a plug here for the importance of sport in our lives, and then I'll get to a little rant as well, and love to hear your thoughts. So, sport, I think, is something that's it's a key ingredient for a good life. One, just because it inspires us to be better, right? Athletes show us what's possible. And oftentimes, great athlete will show us things that we didn't even think was imaginable, right? I mean, they'll have feats of ability that we just, might never thought a human can do. And of course, once they open our eyes, it encourages us to try new things, right? And a great example of this was Roger Bannister, right? The guy who broke the 4-minute mile, right? It was forever conceived or perceived as an impossibility. It was just something that the human body couldn't do. Then when he broke it, I think something like 28 people broke it in like the next 2 years, right? Because they now knew it was possible, right? I think it's especially great for kids, right? There's so many benefits that come from kids participating in sports, everything from just building confidence in what they're capable of doing. Obviously, the physical benefits of being active. Very importantly, kids learn that they get better with discipline focused and practice. Hey, if I keep working at something, I see that I get better at it. Oh, great. How can I apply that to other elements of my life as well, right? A really important one is that they learn that failure isn't fatal. Hey, I can strike out, I can miss the catch, I can trip in the race or whatever, and the world didn't end. I pick myself up, I dust myself off, I try to do better next time, right? Again, these are all life skills that will serve them throughout their lives. And then, of course, they learn all sorts of important social and coping skills, right? I didn't like that call. We're going to argue about it. Hey, this guy got away with it. The ref didn't see the foul. Whatever. You just learn how to deal with adversity, and that's a very important life skill that comes along from there. Last, it's I think, great and really important for adults to keep sport in their lives. One, it keeps us active, right? The older we get, it gets easier to become more and more sedentary, and that has all sorts of bad health issues along with it. And not only does sport bring joy into us with the fun of playing, but as they say, in fitness, like the most important movement to do is the one you're going to keep doing. And
Right.
so if the fun of sport gets you out every day or gets you out, once a week or whatever, then that's the great incentive that keeps you going, keeps you active. And again, it enriches your life. And of course, there's all sorts of other social benefits and stuff like that as well, and the health benefits. So anyways, I'll take a pause there before I get to my rant, but I know that you're a big sports guy. So what would you add to this discussion?
That sports are also entertainment, right? In a couple weeks, my wife is going to become a Sunday widow. It's a way to escape. It's a way to kind of just stop focusing on politics and the markets and everything else going on in the world, and just focus on these incredible athletes that are performing things that like you said, 20 years ago, what these athletes can do is shocking compared to what they did 20 years ago and what they did 20 years before that. And it's like a movie. It's like every other form, going to a Broadway show. It's a great form of entertainment and escape. And there's a lot of lessons too, right? Expect the unexpected. It's like we've been talking about with confidence. You never know how confidence is changing. Just like you don't know, it's very easy to say that, your San Francisco 49ers could very easily beat my Commanders. But when they go to actually play, things turn out very differently sometimes. So it's very unpredictable, no matter how predictable you think things are. The best team in baseball wins 60% of the games. The worst team wins 40% of the games. There's not that much difference. So it just provides a lot of entertainment and a lot of lessons kind of on odds and kind of how life really works. So.
Yeah, and kind of tied to that too, there's, humans are tribal animals. We talk about this a lot, right? And there are certain things that kind of really unite us in community.
Right.
Music is a great example of one, right? But sports is another, right? And it's kind of a way to commune, kind of with your fellow man, not unlike, the tribe probably did around the tribal fire when they were, I don't know, getting ready to do something against the tribe that lived across the river or whatever, right? I mean, there is something very kind of primal about the human connection that comes through bonding over sport.
And it's, we see that in politics too. Politicians have figured that out. You're either on the red team or the green team, and you're going to vote, you're going to root for that team no matter what they say. And, it's again, it's a reflection of life.
It is, although I would say that sports is a much better manifestation of that. Yes, there are some great sports rivalries where you really don't like the other team. I grew up in Boston, so I'm a diehard Red Sox fan. We always hated the Yankees. But yeah, I wish those folks ill will during the game, but afterwards, we're all still humans. Where I think politically, that tribalism is trying to get us to really truly hate the other person. So sports is a much safer environment for that. All right,
Except
well,
in
look,
Philadelphia. If you ever been to an Eagles game, you may not feel the same way.
okay. So here's my one little rant on this, which is, I mean, I agree with your point about, it's amazing to see how the human capability just seems to keep evolving with every generation. You put a LeBron James, against the best player in the NBA from 1923 or whatever,
Right.
it's just going to be a no contest, right? Um, but I do think that we over reward professional sports with our time and our attention and our money. I actually long stopped going to professional sporting events just because I'm not that big of a sports fan
Mhm.
that, if I wanted to go to a San Francisco Giants game, for example, if I want to take my family, like if I want to take a family of four to the Giants game, I mean, it would probably cost $1,000,
Right.
right? When all was said and done, right? And I'm just not that big of a sports fan, right? And at the end of the day, yes, I'm impressed by, you know, a 100-mile-an-hour fastball, right? But I'm impressed by a 90-mile-an-hour fastball too, right? And
Right.
my point is local sports are really just, I mean, once you're sitting there in the stands, you're just as engaged as you are, you know, in the stands at a professional sporting
Right.
event, except you're watching people in your local community who are probably not getting paid at all for the game, especially if you're watching like a high school game or something like that,
Right.
versus you're watching, you know, guys that are, you know, turning down $1 million contracts for hopes of getting, you know, even more millions, right? I mean,
Right.
it's so unbelievably lopsided in terms of attention and money and whatnot. And honestly, like local sport, I think you're maybe even more engaged, especially if you know the people who are playing the game, right? If that's your kid, if that's your neighbor's kid, or you know somebody you know, right? And so, kind of just the plea I'd sort of just make in general is you know support local sport more. There's so many benefits that come from that, both individually into your community and whatnot. And like I said, you get just about the same amount of enjoyment out of it versus the gazillions of dollars that we pump into professional sports. And I'm not saying we shouldn't have professional sports. I just
Right.
think they're way overcompensated.
Well, like a lot of things, our priorities and where we spend money is not really in our longer term best interest. It, you know, goes way beyond sports to many other
Yeah, absolutely.
entertainment in general. I mean,
Sure. Yeah. Same thing with musicians. Yeah.
right.
Yeah.
Well,
Um,
some musicians, Taylor Swift is, God only knows what she makes, but there's so many good local musicians that are outstanding that are making nothing. Like it's shocking how good some of these people are that you can go see at a local bar. And if there's a $5 cover, that's a lot, right? And they're making a couple $100. They are outstanding. So it's not just sports. Check out local musicians and other entertainment.
I'm right there with you. And it is amazing that you can see some of these musicians you're talking about and be blown away, right?
Yeah.
And you know, I'm not denigrating Taylor Swift, but like, you know, Taylor Swift, her music might be better, but like you have a guy like you said who is making peanuts to next to nothing for
Right.
about, you know, talent that's close enough versus a Taylor Swift or Beyonce who when they go on tour, they actually move GDP, right?
Right. Right. Right.
It's mind-boggling that
Right.
one individual can have that much economic impact in the world, but they do, right?
Right.
All right. Well, look, Michael, it's been fantastic. Thank you. I'm going to let you have the last word. Just a couple quick housekeeping items first. First, folks, if you've enjoyed having our highly enriched guest, Michael, here sitting in for Lance, would like to thank him and invite him to come on the program more often. Please let him know by hitting the like button, then clicking the red subscribe button, as well as that little bell icon right next to it, like I mentioned earlier, and make sure that your device is set to receive alerts from YouTube. If you are, you know, are interested in potentially building a bond ladder of your own, or just getting help in navigating your own personal finances, your financial portfolio ahead, given all the macro issues that Michael has talked about here, then consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses, maybe even Michael and Lance and their team there at RAA. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple of seconds. And the consultations that you can have with these firms, they're totally free. There's no commitment to work with them. It's just a free public service these guys offer. Last and very importantly, I want to remind folks that we're now less than 2 months away from Thoughtful Money's fall conference. Michael will be speaking at that as well, so you'll get his latest bond market update there. But very quickly, let me just walk through everybody that we've got lined up for it so far. We're going to have Lacey Hunt kick it off, former Federal Reserve senior economist. If you've seen one of my previous conferences with Lacey and all the data that he brings to the presentation, you'll understand why folks say that the keynote is worth the full price of the event in and of itself. Lacey will be followed by Stephanie Pomboy. She'll be giving us her macro market outlook. We'll have Darius Dale there giving us the latest that his incredibly detailed model is predicting for where things are headed. We'll have Michael Pinto giving his market outlook and sharing what his model is telling him. We'll have former Federal Reserve executive Thomas Honig on the program. That was a huge get. And I've asked Danielle DiMartino Booth, who's a former Fed official, a former Fed advisor, to interview Thomas instead of me. So that's going to be an amazing discussion. After that, we're going to have Michael himself come talk about the bond market, give us his latest read on what's going on there. He'll be followed by Stephen Bavaria of the Income Factory fame, and he'll be giving his latest on how to build an income-generating portfolio. Following his framework, he'll also be sharing the specific tickers of the instruments that he is most excited about or looking at most closely right now and building his own income factory. We'll have Dollar Milkshake creator Brent Johnson there giving us his outlook on the US dollar, to then be followed by Lynn Alden, who will be talking with us about how to protect against the loss of purchasing power of fiat currencies like the dollar. So she'll be talking about Bitcoin, she'll be talking about precious metals, a few other assets. She'll then be followed by Melody Wright, who will be giving us an update on the housing market, who will then be followed by Rick Rule, who will be giving us his top picks for resource stocks. And if you've attended conferences in the past, you know that Rick brings something like 40 to 50 tickers for folks to consider. He just leaves it all on the table. And of course, we'll have our regular financial advisors there throughout the day, so you can ask questions of them directly. That'll be the guys from New Harbor. It'll be Lance from RIA and Jonathan Wellham from Rocklink up in Canada. So anyways, if all this sounds good, go get your ticket at thoughtfulmoney.com/conference. And if you're thinking of going, buy your ticket soon, because we are offering our lowest price discount, the early bird price discount right now. It's not going to be around forever. Want to make sure everybody gets the lowest price possible. And if you are a premium subscriber to our Substack, you'll get an additional $50 off the ticket price. So you get an additional $50 off of that lowest early bird price discount. And just to really be clear on the economics, our Substack only costs $15 a month. So if you want to spend $15 to then get the discount, the $50 off, you pocket the $35 difference. And if you unsubscribe to the newsletter after that, that's fine. If you want to game the system that way, I'm happy. I want everybody to get the best deal they can. All right, Michael, thanks for hanging with me through all that. I like to give Lance the last word every week, so I'm going to give you the last word this week.
No, I would just say everything we've talked about, we showed a few graphs, the picture of the people in the restaurant, that all comes from work that we publish. Lance and I are out there all the time talking about our views, writing about our views, and both of us spend a good amount of time writing. And it's important for us as in our process to write. It helps cement our views and sway our views, but it's also out there. It's available. It's free. So, go to our website, realinvestmentadvice.com, and check out just the way too many articles that Lance and I write, and podcasts and all kinds of other information.
Completely recommend that folks go do that. And what I really like about what you and Lance do there, Michael, and you kind of mentioned this, but like Lance says this all the time. He's like, our articles are us thinking through the issues, so that when Michael and I come to sit down at the table to determine what portfolio changes to make, we feel like we've kind of thought these issues through from a whole bunch of different angles. And so reading your guys' articles not only is educational, but it really helps me keep track of how you guys are thinking and why you make the decisions that you do. And it's great because sometimes you'll write an article of like, hey, I'm going to put on the bull hat. I'm going to try to really make the bull case. And then you'll write an article saying, okay, I'm now going to look at it from the other perspective. So I think it's really helpful for somebody that wants to crawl inside the mind of an experienced, seasoned capital manager. It's fantastic for that.
Yeah. And like I said, it's a great tool that I would still write even if no one was reading it, because it's really just a great way to learn yourself and to really understand something. I think you have to either write or present. Just thinking it through in your head, it's very easy to be lazy, but when you actually have to put it on pen or with a microphone, it gets you to a higher level of understanding. And so it's a benefit to us. But like you said, you get inside our heads,
Yeah.
better or worse.
Yeah, sometimes some of the things I see in Lance's head are kind of scary, but anyways, Michael, thanks so much, buddy. It's
You're
always
welcome.
wonderful having you on here. And look forward to seeing you at the conference there in October. And hopefully, if we don't get you on the channel by then, we'll definitely see you at the conference. Thanks so much, my friend. Everybody else, thanks so much for watching.
Take care.